There have been some massive developments in the Sam Bankman-Fried and FTX scandal over the last couple days. Sam Bankman-Fried has actually now been arrested in the Bahamas as US prosecutors have officially filed criminal charges against him. This arrest was confirmed on Twitter by the Southern District of New York, so it's definitely official. Allegedly, the charges will include wire fraud conspiracy, securities fraud conspiracy, and money laundering. It's pretty clear that Sam and FTX were engaging in massive fraud, but more and more allegations have been coming out for increasingly sinister things. One of the most recent allegations is that Sam and his hedge fund Alamada Research intentionally targeted and caused the collapse of the stablecoin TerraUSD. This allegation is currently being investigated by federal authorities at the moment. This is a huge deal if it's true because the TerraUSD implosion caused massive losses in the crypto space. Since then, there has been a $1 trillion loss in market capitalization in the cryptocurrency sector, and there has been widespread bankruptcies. If Sam did destroy TerraUSD on purpose for profit, it's genuinely a massive villain move that sounds like it's straight out of a movie. For context, TerraUSD is what's considered an algorithmic stablecoin. Stablecoins are always supposed to have a fixed value and be pegged to a specific currency. They function in the cryptocurrency markets as a supposedly stable store of value for investors and traders who are keeping their money in the stablecoin. They are often used as cash equivalent reserves by cryptocurrency companies for this reason. Now, there are two main kinds of stablecoin mechanisms that are supposed to keep a stablecoin pegged to its currency. The two types are collateralized stablecoins and algorithmic stablecoins. A collateralized stablecoin is supposed to be fully backed by other assets held as reserves by the stablecoin issuer. This gives the owner of the stablecoin the ability to exchange the stablecoin at any point with the assets held as reserves. For example, a collateralized stablecoin that's pegged to the value of $1 could in theory be redeemed at any time by its owner for exactly $1 of the lender's reserve collateral, which is why the stablecoin is supposed to always have $1 of value, because you can redeem it at any time for that $1. In contrast, an algorithmic stablecoin does not necessarily hold full assets and collateral to keep its value fixed. Instead, they are designed to have an algorithm keep the price of the coin stable by having the algorithm control the supply of the coin, hence the name algorithmic stablecoin. TerraUSD was an algorithmic stablecoin that was supposed to be pegged to the value of $1 through a relationship with another coin called Luna that was made by the same company. One TerraUSD coin would always be exchangeable for $1's worth of Luna coins at any time. So while the price of a Luna coin could vary at any given point, the TerraUSD stablecoin would theoretically be constant because at any point it could be converted into exactly $1's worth of Luna. And Luna could be converted into a corresponding amount of TerraUSD at any time too. So if Luna was trading at $80 a coin, for example, it could be converted into 80 TerraUSD coins worth $1 each. This relationship meant that whenever the price of TerraUSD was below $1 on the open market, there was an incentive to buy it and convert it to $1 worth of Luna coins to make an instant profit. On the other hand, whenever the price of TerraUSD was above $1, there would be an incentive to convert Luna into TerraUSD to sell immediately on the open market for profit. Because of this fixed relationship between the two coins, the theory was that the ability to convert TerraUSD to exactly $1 worth of Luna at any time meant that an algorithm could keep TerraUSD pegged to $1. But the problem in the design isn't too hard to spot here. The system works great if people expect TerraUSD and Luna to keep their value and are willing to keep their money in the Terra Luna ecosystem. But if demand fell for either TerraUSD or Luna, and money started to get taken out from the Terra Luna combo, the whole system could fall apart if buyers didn't want either coin. This is basically what ended up happening in effect. The blockchain analytics company Chainalysis notes that during a period where some TerraUSD was being moved from one pool to another, there were a series of large trades where TerraUSD was sold that kicked off very large volatility in TerraUSD and led to it losing its $1 peg. Remember these large trades because they are important later on. After TerraUSD lost its $1 peg, investors began to panic and to take their money out of the Terra Luna ecosystem. As TerraUSD lost its peg and fell below $1, algorithms and investors began to convert TerraUSD to Luna in an effort to stabilize Terra's price. But this led to hyperinflation in the supply of Luna tokens that had to be created to facilitate the massive amount of conversions that were happening. This massive spike in the supply of Luna crashed the price of Luna tokens, and the whole thing began to fall apart as Luna's market cap fell below TerraUSD. This meant that the value of all of the hyperinflated Luna tokens in existence were now worth less than even the value of all of the depegged TerraUSD tokens in existence, which meant that there was no longer a guaranteed way for investors to continue converting TerraUSD into Luna and getting a full dollar out of it. Basically, the whole system had collapsed. This collapse of a supposedly safe stablecoin introduced broad contagion in the crypto space, which ultimately created a chain of events that led to crypto exchanges like BlockFi and Voyager Digital being forced to look for emergency funding to prevent bankruptcy. Sam would use this opportunity to extend lifeline deals to companies like BlockFi and Voyager. In the case of BlockFi, the deal even included the option for FTX to buy the company outright later on. But remember those series of large trades where nearly 200 million of TerraUSD were swapped, and how that began to trigger the crash of Terra Luna? It looks like there is a strong possibility that these trades could have been made by Sam's hedge fund Alamada Research, which may have placed a big bet on the price of Luna falling. To make this happen, Sam and Alamada appear to have attacked TerraUSD to cause both of the coins to crash for a profit on their short position on Luna. This is what Terra Luna's founder has also alleged on Twitter, accusing Sam and his companies of borrowing TerraUSD to orchestrate a peg attack and actively trying to undermine the cryptocurrencies. If federal prosecutors find this to be true, it completely changes the outlook on the aftermath of the events after the Terra Luna contagion and crypto crash. The lifelines that Sam Bankman-Fried gave to failing crypto companies could potentially just be him trying to scoop up companies and assets cheaply after he essentially forced them into bankruptcy in the first place by starting the Terra Luna collapse. He could then invest in the companies at a cheap valuation and do it with the money he made from the Terra short as well. Obviously, all of this market manipulation is insane, but ultimately this is what helped to contribute to FTX's downfall. FTX was throwing stones from their own glass house in this situation. Sure, they made money on their Luna short and were able to scoop up crypto assets at a cheaper price immediately after, but they also made the crypto bear market a lot worse in doing so. The collapse of a major coin like TerraUSD introduced even more distrust and scrutiny for cryptocurrency tokens, which helped to create an environment where FTX's own token could crash and become worthless in just days. Which, by the way, if you want to learn the full story of the events leading up to FTX going bankrupt and what caused it, make sure to check out my full video on the subject in the description below. But it's honestly insane that Sam was going around trying to destroy other cryptocurrencies for a profit, and then came along trying to look like the hero afterward by giving loans to the companies that were forced into bankruptcy because of what he did. That's some crazy villain stuff you'd think that you would only see in a movie. Ironically though, he was too short-sighted to see that this would end up causing his own companies to eventually go bankrupt too. It's clear from these developments that there's a lot more to the FTX fraud that federal prosecutors may be uncovering in the coming months. But be sure to let me know your thoughts in the comments below, and leave a like on the video and subscribe to the channel for more finance and investing content. Thanks.